Different concepts are being used in the market, but to know the exact point where you are likely to mark out as your valid support and demand zone is very important when trading different strategies. So here I'll be showing you how you can get a more perfect entry and make more profit trading the forex market. So let's assume the market is moving in an uptrend like this, and we anticipate the market will come to a particular level over here before it continues to break this high. So some people will take their entry like this because they know it is still going up. Take their entry here, their stop loss will be below here, and then they can target small area to the upside. But what if there is a way that you can catch moves all the way down over here? Then you can take your entry here, your stop loss will be below here, and then you can target this high to make more profit or high above. So the problem most beginner traders face is to know exactly where to mark out in their market, especially ICT and SMT traders and supply and demand traders. They don't know exact point where they need to mark their POI to take trades to the upside. So that is why we utilize the FIB tool. So this FIB tool has different levels that can help us to know exactly where market is likely to reverse from. Let's take our FIB tool from this level to this level. So market can react from the 25% level, from the 50%, from the 75%, or the 100%. If we know that market is likely to reverse from this 70 to 100%, then we can take our entry at this point and make more money than when we take our entry from the 25% level. So if we take our entry at the 25%, we are likely to get stop out before we get the right move. So before you understand how the FIB works, the first thing you need to pay attention to is its premium and discount level. So let's say market is coming from this swing point up to this high, and for the downtrend, you draw like this. Let's say this is the downtrend from this point up to this low. So this area over here is the premium level, and this level over here is the discount level. So if you want to see price continue in an uptrend, this is premium level. That means that it is an expensive area, and this is the discount level where the price is cheap. So if you want markets to continue in an uptrend, you are not going to be buying more at the expensive area. You will have to wait for when markets will come back to when it is cheap, when it is in a discount price, then you can buy at this point to the upside. That is to take out this high or continues in its uptrend. And whenever you anticipate the market is likely to go in a downtrend, this is the premium level and this is the discount level. Market is expensive at this point. It comes to the cheap level. So if you want to continue selling to the downside, you have to wait for when the market is cost again, that is in the premium level, then you will sell for those who will buy at the expensive price. While for the buy, you buy from people who are selling at the discount price. So the 50% is demarcating between these two levels. So if you want to buy price to the upside, we anticipate markets to come below this 50 level to buy to the upside. And if you want to sell, we anticipate markets to come into this 50 level before we can sell to the downside, because that is the best price level we can have to take our trades. There is a particular level you want to pay attention to below this 50 level to take your trade to the upside, because you cannot just have your buy position at this point, your stop loss here, and then you will target this 0%. So it will be like trading a 1 hour trade. So you want to pay attention to a particular level over here where you can look for your POI to target that high and make more profit. You can see over here, this is 1 to 3 risk reward. So these levels you want to be paying attention to is the 62% to the 79%. So I call this the golden zone because this is the best price level you can look to take your trade to the upside or to the downside, depending on the market condition. So in between this FIB level, you can actually look for your POI, but sometimes market will not come into this level before market continues to move to the upside or the downside, and sometimes it can also weak it, that is take you out before it go in your intended direction, and sometimes it will just reverse on you and then continues in the opposite direction. It all depends on your analysis from the higher time frame. So you cannot only use this FIB retracement for your entries, you need to pay attention to the higher time frame and also do your top-down analysis before you can implement this in your trading and increase your profit. So this is the fib level that we are talking about. The level between the 62% and the 70%, I call it the golden zone. So I will look for my POI around this level to take price to the upside or to take price to the downside. So to set up your fib, so you will tick this 0, you tick this 0.5, then you tick this 0.79, 0.62, you tick this 1 also. You can also edit it if you don't have the level marked. Then you choose the color of your choice. Then you can set this setup as you want. After that, you click on OK. So you will have your fib to look exactly as you see over here. So now let me go to my chart and show you some example to confirm to you that these golden zones actually work. So you can see at this point, the market has broken structure to the upside. So we anticipate that market will move, come down here, and then break structure to this side. Then we have this swing low because this is the swing low that was created before the break of structure, and it's the swing low before we have this high. So if I take my fib and mark out this level from this point up to this high, you can see this engulfing candle at this point. This can be your demand zone. So your entry will be here. Your stop loss will be exactly at this low, and then you can target the high above. So you can see how market comes, dips into that level, the golden zone. So once you have that, the market continues to push to the upside. This is the 4-hour time frame in Euro USD. So let me show you another example. So over here, we have a downtrend. Market has broken structure to the downside around this point. And then we have this swing high and swing low. You can take your fib to mark from this swing high to this swing low. So you can see at this point, if you drop to the 1-hour time frame, you can see that there is a bearish candle. You can use this candle that is inside the golden zone. Your entry can be here. Your stop loss will be above here. Then you can target this low to the left. You can see how market spikes to the downside and hit your TP. So you can use this in the lower time frame as well as the higher time frame. So you can see at this point, market has broken structure to the downside. This is the lowest low and this is the highest high that we have. And draw our zone from this high up to this low. So you can see that there is an engulfing candle at this point. So from this area, we can have our entry here. This is another short example. And then you can target more to the downside. So it is not compulsory that you use engulfing candle or pin band candle. You can actually look for another POI, maybe if you use doji candle or fair value gap, but it must be inside that golden zone, and your stop loss must always be around the swing high or the swing low before the golden zone. You look for the nearest point inside that zone to take your entry to the downside or to the upside. So over here, market shift structure to the upside. You can see how market has been moving low, 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 then breaks this point to the upside. So this is confirming to you that market is likely to continue in an uptrend. So once you have that, this is where you have the break to the upside over here. Then you can take your fib tool and mark from this low up to this high. Then you want to pay attention to the golden zone. So you can see at this point, we have this candle. Then we have a fair value gap inside the candle. Over here, a small fair value gap. So you can see the market taps into the fair value gap to buy to the upside. You can have your entry here. Your stop loss will be below this low. And then you can target this high to the upside. And see how market continues to continue to the uptrend. So currently, we are still seeing some bullish action in good market. So this is how you use the fib tool along with your previous strategy to trade and make more profits out of the market. I said you cannot just go on your chart and mark out this low and mark out this high because you see a break of structure. Then you are looking for the golden zone to take market to the upside. Sometimes it will fail, sometimes it will work. But the best time you get more out of this strategy is when you use it along with your previous trading strategy. So if you combine it with your trading strategy, then you will be able to select the right zone where market is likely to test to send price to the upside or to send price to the downside. So if you find this video helpful, don't forget to like this video, subscribe to this YouTube channel, turn on notification bell so that you get notified anytime I release a new video. You can also check out my other videos that are displaying right now on your screen. Thanks for watching.